The topic that we have to do today is money supply. In the last class, we have already done the meaning, the working, and the qualities of money. But this time, what we're going to talk about is how money can make trend in the economy, how the quantity of money supply is determined in the economy, and is there any role of commercial banks and people in the relation of quantity of money in the economy. We will also study what are the components of monetary aggregates. Also, how the commercial banks contribute in the money supply. We'll also study what is the current condition of money supply in India, that is, what are the monetary aggregates that are used by India. So, let's go to the next slide. Okay, so in this slide, we will be studying about the money supply, its meaning, and the definition. So we can see money supply, meaning, and the definition. See, the purpose of money supply is the quantity of money available in an economy. This is a stock perception which is measured in time. That is why the addition of total quantity of current currency and the total quantity of demand deposits in an economy in a definite time period is called as money supply. Now, what is the currency? See, currency is the addition of currency coins and notes in an economy. What is the demand deposits, or it is also known as check deposits? It is called that bank deposits which depositor can get on demanding or can take from the bank by the check. So we know that we deposit our money in the bank regularly, and that money can be taken out by giving checks, or we can even take it from cash on demand. So that are our demand deposits or checkable deposits. But our economists are not unanimous on the general definition of money. What do we mean by that? By this, we mean that our economists are not sure that if we'll only consider, as we said, currency and demand deposits or checkable deposits, or something else will also be considered in our currency. What can be other things that we can consider in our definition of demand deposits? See, there are different approaches about money. Many economists consider currency and money deposit as two components of money supply, while other economists, so there are some economists which consider the term deposits as the third component of money supply. Now, what is term deposits? We know term deposits are the deposits which are kept in the banks for some time period. Like we know FD, fixed deposit, and there is RD, recurring deposit. We know fixed deposit is for some time period like a year, 6 months, 2 years, and so on. Similarly, recurring deposits is also for a time period, but there you have to give money every month or every quarter as you decide. So some economists say that we should also consider term deposits as a component of our money supply. In actual, if only current currency and demand deposits will be included in the money supply, then we are bound money till the medium of exchange only. But we know that there are many properties of money except the medium of exchange. There is also the base of store of value, which is also an important property of money. So that is why some economists say that we should include the currency, demand deposits, term deposits, and other financial instruments as so as to include the property of store of value in the money supply. So let's see what different economists say about the money supply. So let's go to the next slide. Now, according to Milton Friedman, Milton Friedman, money supply should also include saving and term deposits beside currency in the circulation and demand deposits. Now, as per the economist Edward Shapiro, supply of money is dollar amount of all those things which are generally acceptable by the public in payments of goods, services, and other valuable assets and for discharge of debts. What are debts? Debts are loans. Now, according to economists J. G. Gurley and E. S. Shaw, money should include all those things which are its close substitutes. So, as we saw, different economists see the money supply definition as different terms should be included. So, as we can see that some Milton Friedman says that term deposits should be included. Why should we include term deposits? Because these deposits are for a definite time period and the interest rate on these deposits is decided according to time. See, they can't be converted into cash by the check, because of which these deposits are different from the money deposits. So that is why we can't call them as cash in hand. So question arises that if these deposits are not as liquid as currency, then why should we include them in the supply of money? See, this is because the receipt of fixed deposits is not used in medium of exchange for current and future payments, but also even then Milton Friedman and more economists like him are in favor of including these receipts in the supply of money. His advice is that term, or we can say fixed deposits, can be converted into demand deposits on high discount rate. So the conversion of demand deposits of term deposits into demand deposits take equal time as the payment of high discount rate to the bank. Therefore, he thinks that fixed deposits should also be considered as a part of supply of money similar to the demand deposits. So that is why different economists takes different definitions of money. So now let's go to the next slide and see what are the main components of supply of money which everyone considers as true. So now let's study about what are the main components of money supply. So when we read about the definitions of money supply, every economist agree that there are two main components of money supply. Now what are they? See, first is the currency and second is the bank deposits. So let's read about them in detail. Now, what do we mean by currency? See, in currency, we include two things. One is your coins, another is your currency notes. Now, what do we mean by coins? See, nowadays the coins are released in every country by the government. Though even in ancient times, old era private institutions also used to release coins, but nowadays only government does so. See, government used to restrict the private institution coins in the matter of weights of coins and the purity of metal used in the coins, so that people could be saved from fraud. So there were two types of coins. See, there were two types of coins under the value of gold and silver. One was full-bodied standard coins and another was token coins. See, when we talk about full-bodied coins, see, full-bodied standard coins means that what is the value of the coin and what is the weight of the coin in gold and silver used to be the same. But when we say token coins, so in India we can see that the 50 paisa, 25 paisa, 10 paisa, 5 paisa, 2 paisa and 1 paisa coins are the token coins. This means that even though they say that they are worth of 50 paisa, but actual weight is not so in gold and silver. So that is your token coins. So nowadays what is prevalent in the managed currency system, there is no importance of full bodied standard coins. So those are not in use now. Even the Indian rupee is neither a full bodied standard coin nor a token coin. So we have already read that this 50 paisa, 25 paisa, all these are token coins. But these token coins are also not important components of the money. Even though a large quantity of small coins are in circulation because there is poverty in India, even then it is only a very small part, like 3.5% of the total money supply. And in developed countries like America, token coins are even a less part of the total money supply. Now let's read about currency notes. See, currency notes is an important part of the money supply. Nowadays currency notes are released by either the central bank of a country or the government itself. The 1 rupee note is released by the Indian government. So in our country also, by the Indian government, the 1 rupee note is released, but all the other notes are released by the Reserve Bank of India. So in there can be many ways to release these notes or issue these notes, as representation, proportional, minimum fund, variable, constant, etc. So in the era of metal value, paper money was a representative. So it is a representative money. In other words, the metallic base was kept beside these notes. What do we mean by that? So if the central bank was releasing the notes of 1 crore, then it had to keep the gold or silver of the value of 1 crore in the treasury. Now let's go to the next slide and read more about this. So as I said that in the era of metal value, paper money was the representative. If central bank was releasing the notes of 1 crore, then it had to keep the gold or silver of the value of 1 crore in the treasury. So the two main objectives of doing this to release the currency representation letter were, what were the two main objectives of doing this? See, first was the saving of the cost of minting coins. And what was the second one? It was protection from the loss from rubbing the metal. See, when the metal will be exchanged in the economy, then its value will decrease. There can be depreciation. So to protect that, currency representation letters, or we can say currency notes, were introduced in the economy. But the system of note release was inflexible because the supply of currency letter was dependent on the metal stock. So even though you were exchanging currency notes, but same value of metal stock had to be given by the government, or we can say the central bank. So this made the system inflexible. So to remove this weakness of the currency representation letter, proportional method was adopted. What did that mean? See, Reserve Bank was releasing the notes on the base of proportional reserve system till 1956. According to this system, 40% of the value of entire notes was kept in gold, silver, foreign assets and foreign currencies. After 1956, minimum reserve system was adopted. According to this method, it is compulsory that reserve banks has to keep a minimum fund of 200 crores in reserves, in which the gold should be of 115 crore rupees in reserves. Now there, on the base of the minimum fund of rupees 200 crores, Reserve Bank can release the notes without until any limit. Now this system is very flexible, but the fear of expansion of many notes occurs. Now the currency notes can be variable or constant. Under the variable currency exchange, monetary authorities have to change the currency note with the metal. And under the constant currency paper, Reserve Bank gives the guarantee to change the paper notes into token coins or other notes, but not to change in gold and silver. So let's see this in the next slide. I hope this is clear. So we have already studied that under the variable currency exchange, monetary authorities have to change the currency note with metal. But under the constant currency paper, Reserve Bank or the monetary authorities gives the guarantee to change the paper notes into token coins or other notes, but not to change in gold and silver. You can already guess that the unchangeable method to release the notes is circulated in all the countries of the world to make this more flexible. Now notes are, if we see, they are actually promissory notes. What do we mean by that? See, monetary authority promises to give coins or other notes in exchange of it. We also know that when we go and want to get any note exchanged, then we don't get metal or gold or silver in exchange of that. Instead, we get other variable notes in exchange of that. So if you want, if you give ₹1,000 note or 2,000 rupees note, that doesn't mean that you will get gold or silver value of 2,000. Instead, you will get notes of 100 rupees, like 20 notes of 100 rupees, which will make 2,000, or similarly 200 notes of 10 rupees, which will again make 2,000. So notes are actually promissory notes where monetary authority promises to give coins or other notes in the exchange of this. So now the note release does not depend upon the stock of gold or silver. The monetary authority, on keeping in mind the needs of the economy, fulfills the requirement of the notes. So the monetary authority, on keeping in mind the needs of the economy, they fulfill the requirement of the notes, that is, they print that much amount of notes or exchange that much amount of notes in the economy. So with this we have done currency. Next we will be studying about the second main component, which is the demand deposits. So let's go to the next slide. So, the second main component of money supply is demand deposits. See, the people in all countries deposit their money in banks. Even we deposit our extra cash in banks so that we can earn interest. Now, bank deposits are of two types. One is the fixed deposits and one is the demand or current deposits. We have already studied that fixed deposits are of a definite time period, 2 to 7 days, more than 7 days, 6 months, 1 year, and so on. And then we get interest after that fixed time period. The check cannot withdraw these fixed deposits. Now, the amount of demand deposits can be withdrawn by the depositor anytime, so the cash in demand deposit form is as liquid as money. This is the everyday deposit that we do in the banks. Even our salary or our parents' salary come in our demand deposits, where the money can be withdrawn anytime by demand. We can either go to ATMs to get the money from this, or we can even give checks to the bank to get the money. So that is why demand deposits are more popular. Now even demand deposits are of many types, like there is salary account, then there is savings account. In salary account we don't get any interest, but in saving accounts we do get interest. So in Western countries 90% of payments are done by the banks. The importance of demand or current deposits is also continuously increasing in India. So its importance is increasing because it is very safe and convenient to make the payments by the check from current or demand deposit account. See, the payment by check is convenient because any amount of cash can be withdrawn by the checks. But the use of high value notes can be unsafe if there is any theft. So banks have the evidence of the payments by the checks because these are noted in the bank accounts, and that is why if there is any problem related to the payment, then it can be solved by the investigations as compared to transfer of cash. Now Keynes included the demand deposits in supply of money in his book A Treatise on Money. At that time, economists like Parker Wills had objected to it. But currently, demand deposits are started to be included in the supply of money as a main component because goods and services can also be purchased by demand deposits. But this is not compulsory that we have to accept the payment by check. Any of the people can deny to take check or accept the check, but to pay in cash is a legal obligation. See, banks give the loan on the basis of money deposited to them. So this is why also it is important because banks give loans on the basis of the money deposited to them. Banks have the knowledge that all the depositors never withdraw their entire deposits at the same time. So if they keep with them a definite proportion of total deposits and give the remaining amount as credit, then they can fulfill the need of depositors. See, what do we mean by this? See, the amount that we deposit in the bank and the amount people take out from the bank in the same day is not same. It is always less, the one which is demanded. So that is why this is also known by the banks that the amount that they will have deposited and the amount that they will be demanded to give back will be different, and they can use this amount to give loans or credit to other people. This is the reason that banks are in the situation that however total deposits they are having many times greater than that they can credit to the people, that is they can give loans to the people. This activity of banks is called as credit creation. We will read about this in the further slides. So the credit created by banks is also included in the supply of money. Why? Because it is a part of our demand deposits. So that is why money supply should also include saving and the term deposits beside the currency in circulation and the demand deposits. Now in the next slide we will read about what are the monetary aggregates and what are the money supply measures in India. So let's go to the next slide. I hope all this is clear to you. So let's read about the monetary aggregates and the money supply measures in India. So even though there is a question of what kind of monetary supply or monetary aggregate measures were being used in India, only one supply measure M of money was being used by the RBI till 1967 to 1968. Now what did this M include? M used to include people's demand deposits and the currencies. So that is why M was traditionally called as a narrow money supply measure. Why narrow money supply measure? Because it only included the currency and the demand deposits. So from 1967 to 1968, we had only one money supply measure, which was M. Now let's see from 1967 to 1968 and then till 1977. So from 1967 to 1968 till 1977, a detailed money supply measure that was used as aggregate money resources, or we can also say AMR. So in AMR currency, the demand deposits and the term deposits were included. So during this time period from 1967-1968 to 1977, a aggregate which was used was aggregate monetary resources, which also included term deposits along with currency and demand deposits. Now in 1977 AD, so we can see that in 1977 AD, Reserve Bank of India, that is our RBI, or we can say the central bank, they propounded four new measures of money supply, which are M1, M2, M3 and M4. So four new money supply measures were propounded or were given by RBI in 1977. So let's read what were they or what did they include. So let's go to the next slide. So let's read what does the M1, M2, M3 and M4 monetary aggregates include. So see, first let's read about M1. So M1 included currency of the public, or we can say cash in the hands of the public, plus the demand deposits of the bank, or we can say the deposits on demand or checkable deposits in the banks, plus other deposits of the RBI, which is our central bank. Now see, the M1 and M aggregates are different, so don't confuse them. Now let's talk about M2. See, M2 included currency of the public, or we can say cash in the hands of the people, plus demand deposits of the banks, plus other deposits of the RBI, plus deposits in the saving plans of post office. So we can easily see that what is M2. The first three measures is the same as what we had in M1. So we can write M2 as M1 plus the deposits in saving plans of post office, or we can say post office savings. So M2 is M1 plus post office savings. Okay. Now let's see M3. So M3 included currency of the public plus demand deposits of banks plus other deposits of the RBI plus the term deposits of bank. See, even in AMR, term deposits of bank were included, but that does not mean AMR and M3 are equal. So we can also write M3 as what? See, first three terms are again equal to M1. And with this, what we are adding? We are adding the term deposits TD. So we can also write M3 as M1 plus TD. Now let's see the last aggregate, which is M4. So M4 included currency of the public plus demand deposits of bank plus other deposits of RBI plus the term deposits of bank plus the total deposit of post office except the NSC. So we can see that M4 includes M1, it also includes M2, it also includes M3 and also all other deposits of post office. So plus other deposits, because this time we have said total deposits, not deposits in saving plans. So other deposits of post office. Yes, so we can see that M4 is the broad measure of money supply, and with this we have done M1, M2, M3 and M4, where M1 was the most narrow measure of money and M4 was the most broad measure of money. So now let's see what all other measures have been given by the RBI. So let's go to the next slide. Now in 1998, the Executive Committee of RBI advised two new measures as NM2 and NM3. And besides this, committee also advised three liquidity measures as L1, L2 and L3, and these three are called monetary and liquidity aggregates. So let's see what does they include. See, NM2 includes the currency of the public plus the demand deposit plus other deposits of the RBI plus the short-term deposits. Usually when we talk about short-term deposits, it includes less than 1 year deposits. Okay. Now NM3. See, NM3 includes all the measures in NM2 plus long-term deposits plus short-term fund of financial institutions. So here by long-term deposits, we will say that the deposits which are for more than 1 year, they come under long-term deposits. Now let's talk about L1, which is the liquidity aggregate. So includes everything in NM2. See, remember, this is NM2, not NM3. So everything in NM2, which is currency of public, demand deposits, other deposits of RBI, plus short-term deposits. And with that, we'll add the deposits of the post offices. What about L2? See, L2 includes term monetary receipts. What do we mean by term? When we are keeping it for some time period. Plus the certificate of deposits plus the term deposits. So see, these are monetary receipts and these are deposits. Again, term means for a time period. What about L3? So L3 includes everything in L2. So see, this is L2 plus the social deposits of non-banking financial institutions. So they are talking about non-banking financial institutions. So now here we have been saying other deposits of RBI. But what does these other deposits of RBI include? See, it shows the deposited amount in RBI besides the government and the commercial banks. So besides the amount that the government keeps in the RBI and the commercial bank keeps in the RBI, other deposited amount in RBI means these other deposits of RBI. What can be these other deposited amount? So the demand deposit of international organizations, then the foreign central banks, the foreign government and the financial organizations and so on and so forth are included in this. So this is what we mean by other deposits of RBI. So now let's go to the next slide where we will see that what are the factors which influence the supply of money. So now we will see that what are the factors influencing the supply of money. See, according to Professor Chandler, the supply of money in an economy depends on the following elements. First main component is the size of monetary base, which influences the supply of money. It is also called as high powered money or outside money or reserve money. So high powered money or outside money is said to be that money which the Reserve Bank or the government releases and which public and banks keep with themselves. So we can say that H is equal to R plus C. Now what is this H? This H is the high powered money. What is R? R is the total reserves of the banks. And what is C? C is the currency in circulation. So when we add the currency in circulation or currency in the hands of the public, and when we add the total reserves with the banks, then we get our high powered money or outside money or reserve money. So high powered money can be written as total reserves of the banks plus currency of the publics, which could include notes and coins. So this is the size of the monetary base. So let's read more about this in the next slide. So let's read more about the high powered money. See, the difference in money and high powered money is that money includes demand deposits besides the currency. while high-powered money includes cash reserves of the banks beside the currency. So this is the demand deposits which are kept by the people in the banks, and this is the cash reserves of the banks. So the money that banks keep aside as reserves. So this is included in the high-powered money. See, supply of money then increases when there is an increment in the high-powered money. So we can say that high-powered money positively influences the money supply, as when there is an increase in money supply, increase in high-powered money, similarly there is an increase in the supply of money. Now the size of the supply of money depends upon the money multiplier. See, money multiplier is the ratio of high-powered money and the sum of the total currency, the required reserves of the bank, and other deposits of the banks with the central bank. So what is the money multiplier? It is the ratio. Ratio of what? The high-powered money and the sum of all these things. What does it include? The total of currency, required reserves of the banks, and other deposits of the banks with the central bank. So we can say that my money supply. So this is my money supply. This is positively related to the high powered ratio or high powered money in the proportion of the money multiplier. So this is the money multiplier. This is the high powered money and this is the money supply. So hence we can say that when my high powered money it increases, then my money supply also increases in the proportion of the money multiplier. So I hope this is clear. So this is the first component or first factor which influences my money supply. Now let's go to the next slide to read about the more factors. So the second factor that influences my supply of money is proportion of cash and demand deposits. So this thing also affects the supply of money, which is the ratio of cash and demand deposits. See, people will want to keep however larger proportion of money in deposit form, and as larger will be the power of banks on the basis of those deposits, as banks use these deposits to create credit. So the quantity of credit creation depends on the size of the credit multiplier. Now what is this credit multiplier? So the size of credit multiplier is affected by the cash reserve ratio, which is CRR. The proportion of total deposits banks have to keep themselves as cash is called as the cash reserve ratio CRR. You would have heard about this, as it is the RBI which determines what will be CRR. So it is the proportion of total deposits that banks have to keep as cash with themselves. There is another thing known as SLR, which is statutory liquidity ratio. This is also something that is determined by the central bank, but this is the cash reserves, or this is other reserves that RBI has to keep, banks have to keep with the RBI. But again, it is determined by the central bank or RBI in India's case. So the cash reserve ratio will be as smaller, the power of credit creation of banks will be larger, and the supply of money will also be increased as much. Therefore, if people would like to keep more part of total money as deposits, then supply of money will increase. So we can say that the supply of money is inversely related to what? To the CRR. See, let's understand this. We are saying that the banks create credit on the basis of demand deposits that they get, right? So if a portion of the deposits, which is CRR, has to be kept with themselves, then this reserves cannot be used to create credit. So this much amount banks have to keep aside and cannot be used. So if this is in higher proportion, so we have to keep a high proportion, maybe 5%, 10%, 15%, as has to be kept aside, then that much amount cannot be used to make credit, and the money supply will what it will decrease. So that is why they are saying that the cash reserve ratio will be as smaller, then the credit creation will be higher, and again the supply of money will increase. And now if the public keeps less amount of money with the banks, then that money cannot be used by banks to create credit. So that is why if people would like to keep more part of their total money as deposits, then the supply of money will increase as the credit creation power of banks will increase. So that is why the proportion of cash and demand deposits affects our money supply or influences our money supply. So now let's go to the next factor. So the third factor which affects my money supply is the velocity of circulation. See, to estimate the supply of money, economists have two approaches. First, we can find the supply of money at a point of time. So at a given time of point, what is the supply of money? So this has been the approach of economists of Cambridge University. Like there is Marshall, Pigou, Robertson and Keynes. So their approach was that at a point of time, the supply of money can be estimated by the sum of currency of the people and the demand deposits at that point of time. So that will give me my money supply. But the second approach was supply of money in a period of time. So this was given by the quantity theory of money, Irving Fisher. So Irving Fisher was interested in knowing that in how much amount of money supplied at a special time period. So he was interested in knowing about how much money is supplied in a special time period. So it is a flow concept in a period of time, not at a particular time period. So let's go to the next slide. So in a special time period, the unit of money can be used many times so that a unit of money can work in more than one unit. Let me give an example. See, if assume that a unit of money is used average 7 times in a year in India. So I am using it for a 7 times. Okay. Please excuse my handwriting. So 7 times. Now it would be said that a single unit of money has worked how many units? It has worked for 7 units. Yes, and that is why I can say that my transaction velocity of money, which I can write as V, is how much? It is 7. If I write it in words, then velocity of money is the number of times a unit of money changes hands in the course of a year, and this also influences my money supply. Therefore, the supply of money in a definite time period can be estimated by multiplying the quantity of money with the circulation velocity, which is this V. So we can write this as supply of money is equal to the quantity of money M into the circulation velocity V. And this is why my velocity of circulation or velocity of money also influences my money supply. So with this, we are done with the topic of money supply. I hope you can understand it. Thank you.